Hello, ladies and gentlemen. Sorry about the mode of showing you this information today. There is power outage and it's really bad, but the music has to go on. We have 2 minutes. We have 2 minutes. It's currently 8:58 p.m. It's raining heavily. There's no power, but we are going to do this. So we are anticipating the federal fund rates to come in the next 1 minute 50 seconds. We don't anticipate a lot of we expect this data to remain constant, whereby the interest rates are going to be at 4.5%. Basically, it's between 425 to 450 basis points. We shall talk about that in the next few seconds. But let me just do this. Let me pull up my MetaTrader. So for today, the bias is I'll anticipate that there's a possibility we might see a stronger dollar. So we have less than 1 minute, 15 seconds to go. I'm going to wait for the press conference. I'm going to wait for the press conference, which is going to happen 30 minutes later. This is what I'm going to be anticipating, the FOMC press conference. But at the moment, this one usually doesn't have a lot of impact in the marketplace, but you want to look at it also. You want to look at the interest rates. We want to look at the economic projections. There's a website I'm going to share with you at the end of the video whereby you can be looking at this data in a more detailed manner. But currently, at the moment, this is what we have. So I'm anticipating a stronger dollar for today. As you can see, prices have been really struggling, breaking all-time highs at 30.45. Okay, I'll enter a small position, a sell on 0.05. I'm going to enter one sell there. I'm not going to have a stop loss because this is news releases. With news releases, basically, yeah, we don't have stop losses. So the data is going to come out right now. So we don't anticipate it to be much more different. So it's 4.5%. Basically, that's what we had forecasted. So prices are going against me currently at the moment. I'm running in a drawdown of $30, but this is a small lot size. I want to use a martingale strategy today, and this is the perfect day for me to show you how this strategy usually operates. So we are going to wait for the conference 30 minutes later, whereby we are going to be looking at what Jerome Powell has to say. So I'm going to pause this stream right here, but I'm going to be updating the screenshots regularly on how prices are going to be moving on. But remember, I'm anticipating prices to be very bullish for the dollar, whereby I'll anticipate prices. So my take profit, I'll have it at this is going to be a swing trade, so to say. There's a possibility I might hold this trade back to 3,000. That's where I'm going to have my stop loss at. So, not my stop loss, my take profit, sorry, at $3,000 an ounce. So, it doesn't have to be perfect. Somewhere around there. Remember, I'm not going to have a stop loss, but I'm willing to hold the drawdown. Now, you have to look at your account size, ask yourself, like, are you willing to hold the drawdown? I have a decent account that I'm willing to use martingale on this particular execution. So I'll see you in the next 30 minutes. Welcome back. Welcome back. So the trade is still going on, not a lot of drawdown. Now, the most important thing is about to happen. And I was looking at this document. So there's a possibility by the end of the year, the federal funds rate, as you can see here, the median is at 3.9, meaning there's a probability that before the year ends, we are going to see further interest rate cuts. Now, that's negative for an economy, and we are going to talk more about that. But for now, I want us to go over to YouTube.
To gauge inflation
So, this is
expectations.
what we are looking at
What do you think they
currently.
are watching? Because it doesn't seem to be the survey data.
Or is it the survey data? Have they been spooked by that? Is it the hard data? Is it both?
I think it's a combination of both, and I think it's also going to do from their survey of small and mid-sized businesses, see what they're going to do with the price increases and see how much of those they'll push through.
How much
So
weight they put on all
Jerome
of
is
this will
about
be
to speak
incredibly
any moment
important.
from
The chairman
now.
of the Federal Reserve with a very challenging news conference. That news conference.
Okay, so this is it.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the
So I'm
benefit
going
of
to
the
enter
American
another
people.
position.
The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest
So
rate unchanged.
the majority of
We also made
the
technical
volatility
decision to
usually
slow the
comes
pace
during the
of decline in the
questions.
size of our balance sheet. I'll have more to say about these decisions after briefly.
Hi everyone, let me
Oh
share
my
a trading
lord, you
secret
don't
with you.
say.
When I first dipped my toes into trading, I was searching
You don't say.
2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of
Yes,
2024.
CPI has been on the rise.
Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat
Okay,
lower
that's
than
good.
projected in December,
Oh, that's bad.
and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery.
Okay.
Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer
from
Price
this
Index
speech I
and
need to
other
have a
data
stop
indicate
loss.
that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%.
Okay.
Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are
So
mentioning
this is
tariffs
more or
as
less
a driving factor.
$120-something I'm
Beyond the next year
risking.
or so, however,
Not
most
bad.
measures of longer-term expectations remain consistent with our 2%
But if it goes well, I'm
inflation
going to
goal.
make a pretty
The
decent
median
amount of
projection in
money
the
in
SEP
return.
for total PCE inflation is 2.7% this year and 2.2% next year,
Okay, so
a little
let me
higher
take a
than
screenshot
projected in
for my
December.
people.
In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our
I'm not
dual
going to add
mandate
any more
promote
position.
maximum employment and stable prices for the American people.
Okay.
At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%.
Yeah,
Looking ahead,
4.2
the new
to
administration is in the
4.5.
process of implementing significant policy changes in 4 distinct areas: trade,
that's Trump.
immigration, fiscal policy, and regulation.
Okay.
It is the
He's
net
talking
effect
about
of
Trump.
these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback,
30-60 is a
and we will take on
psychological
board
level.
lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for
To
monetary
recover the
policy:
loss.
maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well
So this is what we
anchored.
call hedging.
Our success in delivering on these goals matters to all
The data is
Americans.
negative. It's very
We
negative. The
understand that our
sales
actions affect
stop loss
communities,
is going to
families,
be
and
hit.
businesses across the country.
Very likely.
Everything
Very,
we
very
do is in
likely.
service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
So this is where the volatility usually comes in.
Howard Schneider with Reuters. Thanks for your time. So 2 things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff
There's a
increases
possibility you are
during the
going to
lowest
all-time
tariff level
highs.
is not very, very challenging. So
Very
some of
high
the answer is
possibility.
clearly some of it, a good part of it, is coming from tariffs. But we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely.
So let me have my stop loss just below that low.
And people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys. But if you look out 5 years or the five-year forward, you'll see that break-evens are either flat or actually slightly down in the case of a longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in
is calling me.
recently that this is perhaps
So within
not
that short
the
minute?
best indication of future spending?
That's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show
So we hit a stop loss, huh?
significant rise in uncertainty
hit a
and
stop
significant
loss.
concerns about downside risks. So how do we think about that? And that is the question.
128 USD.
As I mentioned the other day.
So if this one
as you
nets me
pointed
anything
out,
above 130
the
USD, it's
relationship
okay.
between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of
How much am I
weakness in the
targeting
real
on this?
data. Of course we will.
$300?
But
So let's
given
have
where
it at
we
a
are, we
much
think our
realistic,
policy's in a
because
good
from
place.
46 to 60, that's
We're
like
to react to what comes, and we think that the
100
right thing
and
to
something
do
pips.
is to wait here for greater clarity about
130
what the economy is doing.
pips. So
Nick Timmeros, The Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability
Let's have it at
as
100
an environment
pips.
in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms.
Can you say that today, that we have that price stability, that households and businesses are ignoring price growth?
When you see
So 55
buy
is
in
okay.
advance psychology,
30,
changes in
55.
inventories, and surveys that show consumers, at least in the short run, expect higher inflation.
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at the they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3, and so those two kind of
with these two news releases, prices
so
has
people,
moved more
not
than
everybody, but
150
on
pips.
balance, people wrote
USD
down
card,
similar
we-
numbers. The changes
okay.
aren't that big. The other factor,
The account
though,
is
as I
still
mentioned, is just
positive.
really high uncertainty.
So it's okay.
What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature has been for some time a feature of this labor market. You have pretty high participation.
Yeah, the labor
aging.
markets have been
You've
very
got
bad of late.
wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity.
He did
We've
mention
got
wages are
unemployment,
increasing at a
pretty
higher
close to
rate
its
than
natural
unemployment.
level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And
True.
the
Very
question is,
true.
which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment, because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for
Low
for
hiring,
the
low
last 6, 7,
firing.
8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture.
So these
because
might
so much of it
linger
is
around
indirect.
this region.
A great example
Oh my
is
lord.
their washing machines.
I do
were
believe I'll
tariffed
have
in
to
the
leave this
last
position
round of
running.
tariffs, and prices went up, but prices also went up on dryers, which were not tariffed. So the manufacturers they just kind of followed the crowd and raised it. So things happen very indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last?
Pandemic, yes, during the
Because you
pandemic.
could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course, we're well aware of that. And, you know, it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, you know, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation.
Okay, I'm willing to let this trade play out the way it's going to play out.
We haven't had real price
I'll
stability
keep you posted.
fully reestablished yet, and we have to keep that in mind.